Greetings everyone, Joseph James here from theschooloftrade.com, and in this video series about trade management, a 5-part video series, this is video number 3. Now in the first video we learned about the 3 phases of the move, right? That was the 1 of 5. We talked about the initial interest of the noise, right? The follow-through in the market, and then of course the exhaustion of the move itself. In the second video series we talked about the emotions behind trade management, or the emotional response to your trading. And we found out that the goal was to hit more targets, which would increase our confidence, lessen the fear, and this will of course help us take more winning trades, which will produce better long-term results. Well, of course, in today's video we're talking about the simple and effective method we use to manage our trades. But first, let's remember what our goal is, right? Our goal, first of all, it's to hit more profit targets. Now we know that hitting more profit targets, this builds confidence in our trading to take the next setup. So when I'm confident, I can now be in a position where I'm ready to take the next one. And of course, you're more likely every time you hit a profit target to continue making good trading decisions. One of the biggest things we have to make sure we do is to never let a winner turn into a loser. So hit more profit targets, and then once we hit those profit targets, never let that winner turn into a loser. Now we also learned, right, another part of our goal was to hit fewer stops, right? Sounds simple enough. Hit more targets, hit fewer stops. Well, because stops, what do? They rob you of that vital confidence. Now, in my opinion, I would lose all the money in the world, but if I could keep the confidence, I can make more money with the confidence. Okay, so confidence is more invaluable than the actual money you lose in a trade. Now, of course, with more stops, you're more scared to take the next trade that comes up because of fear of taking a loss. You're more likely to make mistakes in the future because of confusion, fear, and again, excessive fear of continued losses. So, to sum it all up, right, our goal is very simple. We have to make sure that our trade management strategy, the way that we manage our trades, fits these very simple goals. So hit more targets, which means we'll try to use a very tight first target. Okay, that means we'll always have more winning trades. We never want to let a winner turn into a loser. So I'm going to use stop management at my first profit target. And we'll go over that in a second. Okay, so to make sure we never let that winner turn into a loser, we want to manage our initial stop properly. And the biggest thing is, I also want to make sure I'm in a position to capitalize on the big moves in the market. We talked about that in the first video, about the big phases, or the 3 phases of the move. Well, remember guys, I want to be managing my trades so that I can, of course, hit more targets, never let a winner turn into a loser, but I also want to be in a position where if the market begins to really move dramatically, I want to be in the market and be in a position to capitalize on that move. So I'm going to have a wide third or wide final target to allow for a runner, and of course I'll use a trailing stop to lock in profits. So hit more targets, never let a winner turn into a loser, and by all means be in a position where if the market does begin to run on us, we're in the trade and we can of course capitalize because of it. Now, once we've gone over our goals, right, we know what our goals are and we know how we're going to solve those goals, let's also recall the structure of the market. Remember, we have the first 1 to 3 ticks, right? That's the noise. Then you've got the traders jump on right after 3, so say 3 to 8 ticks, 3 to 10 ticks, you've got your follow through. And then of course excessive 10 ticks, then we're looking for your exhaustion patterns, right, the end of the move. So now to capitalize on what the market has to offer, we look at what the structure looks like first. So if we know exactly what the structure looks like, we can now of course plan accordingly. So let's take a look at how we would plan our trade management strategy. Remember guys, keep those goals in mind and also keep the structure in mind. So we have 3 profit targets, and I'm going to use a 6-tick stop here. Now, your stop is very much a variable that will be very specific to your trading. In this example, let's say a 6-tick stop. This has nothing to, my stop has nothing to do with my targets. It has nothing to do, right, with the actual reality of the market. This is a very simple example. Okay? However, what we use right now in the trade room, this is exactly what we use in the trade room. Okay? So it may not apply directly to your situation, but it's what we use in the situation. It's what we use in the trade room. So be aware, guys, that what we're doing over right now may not specifically apply to your specific trading goals, your risk tolerance, or your objectives. So make sure you guys come see us for that custom trade plan, and we'll make sure that this method, of course, fits you perfectly. Well, for what we use in the trade room, guys, we use 3 profit targets and a 6-tick stop. The first target will be very tight. Again, guys, more targets equals more confidence. So the first target should be very tight, right? 3 to 4 ticks. This capitalizes on the noise of the market, right? Remember guys, that first 4 to 3 ticks, that's the noise. It gets a quick winner, And then using our stop loss, we move our stop from entry point down to our point of entry to eliminate all the risk. So that ensures now that a winner cannot become a loser. So right off the bat, guys, we've achieved some very important goals here with our first profit target, which is a very tight target, right? 3 to 4 ticks. It capitalizes on the move, gets a quick winner, and then of course we lock in profit and eliminate all that risk by moving the stop from 6 ticks back to our point of entry, which of course now makes sure this trade cannot become a losing trade. So there's 2 big accomplishments there in the first target. The second target then, of course, we're looking to capitalize on the follow-through. Remember, the second phase of the move is going to be those 6 to 10 ticks there of the follow-through, right? That's where the rest of the traders jump on. So we capitalize on the rest of the market jumping on now with our second target placed about 6 to 8 ticks out. Then our third and final target, remember, is going to be a runner. So there will be no fixed value for that third and final target. We're going to simply trail our stop using a very simple technique on our trade management chart that involves a proprietary indicator, which is a very thick pink line. We look for exhaustion patterns that are also going to allow for a manual exit. And of course, the goal for the third and final target is to lock in as much profit potential as the market will give you. So again, third and final target, we're looking for the exhaustion patterns, we're looking to maximize profit, and we use our trade management chart to do it. So 3 targets. First target very tight, second target capitalizes on the follow through the move, and of course the third and final target looks to lock in as much potential profit that we can possibly bear. So once again, we have the first 1 to 3 ticks, that's the noise, right? That's of course our first target, 3 ticks out, 3 to 4 ticks out. That'll lock in profit, eliminate risk, moving your stop to entry. The second in the center there in the red, of course you've got your follow through. That's our second target, capitalize on the actual move itself. And then the third and final target there, guys, we're looking for the exhaustion patterns when that move finally begins to take a turn, and we trail our stop looking to maximize profit. Now, in the trade room, we go over this in great detail, but of course, we'll take a look first of all, right, where we are on our trade management chart. Now, this is called our trade management chart. It's a very fast time frame, and of course, a couple key components here, guys. A couple key components. As you guys know, after I see my first 2 profit targets filled, I will have already moved my stop to entry. I will have already locked up a little bit of profit, eliminated all the risk, and after I see that second target filled, I'm now going to move my stop from my point of entry to where this pink line is here on my trade management chart. Now, this pink line is considered to be the line in the sand between the buyers and the sellers having control over the price action. We will then, of course, exit our trade. Will be flat in the market once we get filled at that final target. So first 2 targets are filled. We then move our stop up or, of course, down to that thick pink line, depending on which direction you're trading with. Now, we also have a discretionary approach. Now, I'm going to go over the discretionary approach a little bit more detail in our next video, guys. So make sure you stick around for the next video in this series. We'll talk more about the discretionary approach to how we manage our trades. But let's recap about our specific trading method and how we manage our trades. Our trade management method must fit all of our goals first, right? That much we know. We've got to fit our goals, which means frequent targets, right? That'll increase confidence and put us in a position to take more winning trades. We never let a winner turn into a loser. That means the market doesn't go in our direction. Cut at entry. If it does move for us, we'll let it run. But never let a winner turn into a loser. And then, of course, last but not least, always be in a position to capitalize on the big moves in the market with that final target. So take quick, frequent targets, right? That'll increase confidence. Lock in your profit, eliminate risk with that stop down to entry. And then, of course, look to capitalize on the big moves because now you've got no risk in the market, right? No risk. If the market does begin to move in your direction, that's right, let it run. Manage that final position with your runner and use a very simple method of doing so. Now, guys, coming up next, in our next video, we'll talk more about the 2 different types of management. Now, remember, we've talked about the basics here, right? The basic fundamentals behind our methodology and how we manage our trades. Now, let's go into more details. You have to know what to do when something goes wrong. Okay? It's not good enough to know what the management style looks like in a perfect situation, but what do we do live in real time if something goes wrong? So next video, you don't want to miss it. We'll talk about discretionary, of course, following simple rules, and a mechanical approach as well, using different indicators, right, to manage your trades and to really be ready for whatever the market will give you. Once again, guys, my name is Joseph James. Hope the video helps. Don't miss out on the next video in this 5-part series. We'll talk more about discretionary and mechanical use of our methodology of trading and trade management. Once again, guys, we'll see you next time. The trade room is tomorrow morning, 7:45 Eastern Time. Don't miss a tick. Bye-bye for now.